I want to thank everyone for joining us for our discussions with Guardian Capital. The topic of the day is proxy voting and how that is relevant for responsible investing. It's, the ESG side has come into the forefront, especially in the last couple of years, and voting proxies is one of the key areas where companies, where investment managers can have an influence on the companies that they're held in their portfolio. And we have Guardian Capital here to basically help educate us and elaborate on the topic. We have Michelle Robitaille, the Managing Director and Head of Responsible Investing, joining us, and Joel Huron, who is the Associate Portfolio Manager in the One Equity Portfolio. With that, I'll hand it over to the team at Guardian Capital to tell us a little bit more about this topic.
Thanks, Keith. So what I wanted to start off with was just a very quick recap of the strategy, as it feeds well into our assessment of ESG factors and really how we engage companies. So the TSX, as you'll know, can be a problematic index, as it does have high concentration in cyclical sectors, so things like energy, materials, and financials, and then an underrepresentation in sectors like technology, consumer discretionary, and consumer staples. And those sectors are typically home to more profitable and less volatile business models. So with this strategy, what we try to do is increase exposure to the less volatile areas of the market. On the next slide, what this really leads to is a portfolio that is designed to outperform through a market cycle with less volatility and really strong downside performance when markets have a sharp downturn. This is really important as it helps to preserve capital, and the reduced volatility will lead to a more comfortable longer-term journey. So the next slide highlights how we think about quality within the portfolio and how we assess a high-quality business model and a high-quality management team. So there's a few items that I think are worth highlighting. The first is on the growth side of things. We buy leaders that have pricing power and can grow in most market environments through both M&A and organic growth. So we look for a combination or an ability to grow through different avenues. On the profitability side of things, we really look for sustainable levels of profitability. So can that company be profitable through a market cycle and avoid getting pinched if the economy sours? When we think about risk, we really focus on diversification. It's very important at the business level. And the last thing is stewardship, and this is where ESG management engagement comes in. So we look to partner with proven management teams that are focused on sustainably growing their business models or businesses. And I think if there's one thing to take away from this slide, it's that kind of emphasis on stewardship. So great governance is a feature of all of our companies, given we are focused on high quality. We'll often collaborate and engage with boards and management teams, and we're ultimately active owners. But what it really comes down to, and Michelle's going to walk through this when it comes to proxy voting and how we think about proxy voting, but we rarely have to vote against a management team or board just due to the high quality nature of the portfolio, right? We've got a very high bar that's set in the portfolio from the get-go, and so we don't often have to resort to using the proxy votes to set a precedent and draw a line in the sand with these management teams. So I think with that, I'll hand things over to Michelle.
Perfect. Thanks, Joel, and good morning, everyone. Yeah, so I'm just going to talk a little bit. I know the discussion is around proxy voting, but I think it's really important to understand that proxy voting is actually just one of the tools that we use in our broader stewardship approach. And so Joel touched on the fact that company engagement is, I think, first and foremost what we do. So we've always met with management teams in terms of just understanding the company's the business, making sure we're comfortable with the governance that's in place and the company culture. And I would say that with the rise of responsible investing and sort of ESG factors coming to the forefront, I would say our engagement has expanded now to include those factors. They were always a big part of our process anyways, but there are sometimes specific material ESG risks or opportunities that are facing companies that are now part of that company engagement piece. Proxy voting is sort of a second piece, and as we walk through this presentation, I think you'll get a better feel for how those two things fit together. But there are a couple of other elements of stewardship as well, and so one is just collaborating with peers. So there are a number of other asset managers, and so for particular initiatives, particular companies, we might choose to collaborate with like-minded peers if there's a particular issue that we think is really important. So for example, Climate Action 100 is an organization that will engage with companies specifically on climate that we would participate in some of their initiatives with. There's also advocacy with policymakers and standard settings. And so we are a member of a number of industry bodies. So not only the UN Principles of Responsible Investing or UNPRI, but also organizations like the Responsible Investor Association of Canada. So we'll work with those types of organizations on looking at things like the new standards that are coming out or some of the new regulations and provide our feedback as well. So it's all part of a broader approach to make sure that we're actually using our influence as institutional investors to make sure that we're maximizing the long-term benefits, not only for our underlying companies, but also making sure that we're focusing on the environment and on society as a whole. Moving on to the next slide, you can see active ownership. And again, Joel alluded to this, but in terms of active ownership, it's really where we're using our rights and our position of ownership to try and influence the activities and behavior of an investee company. And so the two main ways that we do this is through engagement. And so we'll have often a series of meetings with corporate leaders, and that can either be management teams or it can be boards of directors to make sure that we understand that what sort of their policies are, what their approaches are, and that we question their current practices. We have a good understanding of what best practice is across the industry. We understand what sort of targets companies should be setting and what sort of moves they should be making. And we're there to kind of question them and encourage positive change and make sure that they're moving in the right direction, while also recognizing that some of these changes take time. There are some natural impediments to being able to make rapid changes. And so you have to be willing to work with companies and go at the pace that makes sense for them, but also hold them accountable. So it's really around finding that right balance. Proxy voting is another piece of that pie. And so proxy voting is a very specific activity. And so it really refers to the ballots that are cast at a company's AGM on a particular topic. And it's really sort of a very transparent way to communicate what we're feeling or thinking about a particular issue. And we'll go into that in quite a bit more detail. Before we do, just turning to the next slide, I wanted to talk about what we see as some of the benefits of active ownership. And so another debate that is pretty widespread in the world of responsible investing is around active ownership or engagement versus this concept of divestment. And we're big believers in the benefits of active ownership. And active ownership, again, is basically things like engagement and things like proxy voting, and basically directly communicating with our investee companies on specific issues of concern. And the reason that we like active ownership is because it gives us the ability to influence the company. Because we're a shareholder, it gives us a seat at the table. It also encourages companies to be part of the solution, not just part of the problem. And particularly when you think of hard to abate sectors or players that need to be a big part of things like, for example, the energy transition, it's in fact the oil and gas companies that are best positioned to actually move us through that transition. They have huge amounts of knowledge and expertise. They have the ability to actually work through these issues, and they have a lot of money. They have a lot of deep capital, deep pockets, and they're generating a lot of cash flows. And so allowing them to be part of the solution is actually something that makes sense in our view. And it also recognizes, again, as I said, that some of these things take time. And so what we're looking for when we're talking to companies is really a culture and an attitude around responsible investing and around good ESG practices, and then sort of market progress. Now, if we contrast that to divestment, divestment is really where you're reducing or you're selling outright of an invested company. And it has been something that has been around for a long time. Often it started with things like avoiding sin SOX, alcohol, tobacco, various industries, but it's now become quite a large movement where you're seeing investors basically avoiding large sectors of the market. In particular, you do see it around energy. And in our view, it's not really accomplishing what you're trying to do with responsible investing. So first off, you're losing out on both returns that company is generating, but more importantly, you're losing out on your ability to influence the company. If you're not a shareholder, you don't have the ability to sit down at the table. They really have no impetus to sit down and talk to you and to listen to your views. And probably the more important is that there's no guarantee that divestment will achieve the desired social goal. I think all of us can agree that the whole purpose and the reason that we believe in responsible investing is because we think that creating a better society, one that is taking into account the impacts on the environment, the impacts on the people, the impacts on sort of governance, is going to result in a better world for all of us. And if that is really what the goal is, when you're divesting of a company, essentially what you're doing is you're transferring them to other owners. And those owners may or may not care about ESG issues. They may or may not be willing to engage. And oftentimes they're not. So you're effectively just passing on that responsibility of dealing with the problem to someone else. And you're not really solving the problem. Now, this is a topic, again, that comes under a lot of scrutiny. And so we have written a white paper, which is referred to later in the presentation, and that is available. And I think Brian forwarded it to Keith, and it's available for you in case you're interested in. But it is something that I think is really important to understand in terms of context when we're talking about stewardship as a whole. So moving on to the next slide, just on slide 8. Again, just wanting to go into a little bit about proxy voting. So proxy voting, again, it's a little bit complicated, just to give you some background on how it works. So basically what happens is with publicly traded companies, they all have an annual general meeting where they report their activities to shareholders. As a shareholder, you're a part owner of that company, and that means that you're entitled to attend the AGM, and you're entitled to vote on various company-related items. So the proxy is simply an indication of your vote in advance so that you don't have to attend that meeting. So when we think about the types of votes that are happening at AGM, a lot of votes are routine. They include things like the appointment of the board of directors, appointing the auditors, approving executive compensation plans. But even some of these routine items can actually be controversial. And what happens with this voting process is it gives an opportunity for shareholders to push back on the plans of corporate leaders, to express their discontent around a particular director or a particular item. Shareholders under certain rules are actually also entitled to bring forward proposals for considerations. And so basically what happens is they bring forward a proposal and it's put out to all of the other shareholders to consider. And often what happens is management teams, they don't really like these shareholder proposals because it often forces them to adopt or comply with the item being proposed. But it is an activity in this era of increased responsible investing and an increased focus on ESG factors that you are seeing more and more shareholder proposals. And we'll talk to that in a little bit more detail. So what's really important to note is that those votes can be critically important as they can actually help determine the strategic direction of the company. So turning on to the next slide, again, we talked about the fact that shareholders have actually become a lot more active in using their voting power to influence companies. And so there's two broad categories of votes. And so management proposals are proposals that are sponsored by the corporation. And again, those would be a lot of those routine items, things like particular directors, things like the executive compensation plan, a lot of other issues that management are proposing. And then we have shareholder proposals, which are those proposals that are sponsored by shareholders themselves. And so they're becoming more prevalent. Again, this is really where we're starting to see ESG issues coming to the forefront in terms of engagement. And we'll talk through this in a little bit more detail, but we're starting to see them in areas like climate change, environmental impact, human rights, diversity and inclusion. These are all areas where we're starting to see shareholder proposals because the shareholders are not happy with the actions and progress that companies are making. What often happens, though, is that shareholders will make a proposal and it results in engagement with management to try and address the concern. And so most often, and really the ideal is that management will agree to the proposed demand and then the proposal is actually withdrawn. So that would actually be the best case scenario. But if the agreement can't be reached and if the two sides can't come to sort of some agreement that makes sense, then the proposal will be introduced at the AGM and subject to voting. So moving on to the next slide. Just to give you a bit of a snapshot in terms of environmental proposals and an idea of how they've increased. If we looked at 2020 over 2021, you saw a very significant increase in environmental shareholder proposals that were submitted in the US. So we went from 89 in 2020 up to 115. And the expectation is that in 2022, that number will be even significantly greater. So a much higher level of environmental proposals being introduced. 58% of those proposals were withdrawn in 2021 compared to 44. And what that means is that companies are preferring to engage rather than taking the proposal to vote. So again, the whole power and purpose of that shareholder proposal process is that it often leads to engagement and to companies and shareholders coming to an agreement on the direction that they want to come. And then for the ones that did go to vote, what you're also seeing is that you're getting greater shareholder support than in previous years. And so what happens is that all shareholders have the opportunity to respond to the vote. And generally, if you have more more shareholders that are supporting a proposal, it forces the company to look at the proposal, and particularly if you get a majority of shareholders or over 50%, then it's something that the board needs to address and talk to why they're not addressing it or what moves they're making to kind of address the concern at the next meeting. So it's quite a powerful tool. Moving forward to slide 11. Proxy voting by the numbers. This is just a snapshot for specifically the one fund portfolio. And so this looks back at 2021, and specifically there were about 475 proposals during the year that were voted on by Guardian Capital. What you can see is that the vast majority of them were related to directors, so almost 80%. But what you also see is in the yellow that that shareholder voting proposals in the yellow is about 2.3%. And you can see again, that's the area that is starting to increase. Flipping forward and just talking a little bit more specifically about proxy voting at Guardian, it is something that we take very seriously. We do integrate ESG considerations into our investment analysis and our stewardship activities. And again, that is because we have the objective of enhancing long-term investment performance for our clients. We are big believers that companies that demonstrate a commitment to sustainable environment and social practices generally produce better long-term investment returns for all investors. We do use a proxy voting service, a company that we're using right now called ISS, or Institutional Shareholder Services, to engage and basically to help us manage the process. So as you can imagine, with all of our funds, we talked about 435 proposals just for the one fund. We have a number of clients, so that we have literally thousands. So basically, ISS helps us to manage the process to make sure that all of the proxies are being voted, that all of the management and recording is happening properly. But they also provide a proxy analysis, which is one of the inputs that our portfolio managers use in conjunction with the proxy voting guidelines that we have developed as a company, that basically lets them look at what the different issues are and how they're approaching them. So I think one of the big things to remember is that proxy voting, it's not a simple checkbox exercise. It's something that the portfolio managers put a lot of time and effort into. It's really important not only to understand what the proposal is, but really to understand the context of it in the context of the underlying company. So what is the company doing already? What are the considerations? What are its industry peers doing? What does the proposal look like? So there's a number of factors that go into the decision making. And I would say the second thing is that at Guardian, we do believe that proxy voting go hand in hand. And so oftentimes what will happen is if there is an issue that's brought up through a proxy voting proposal, we might choose to engage with management on the issue prior to voting against that proposal. If we think we have a great relationship, we just want to understand their perspective. And so we might choose to do those two things in tandem, or we might choose to engage prior to making a vote a certain way. But we absolutely believe that you need to be engaging with companies as well as using proxy voting as a tool. So one of the things that I alluded to was the third-party service we use, ISS, which does provide a little bit of an for us on the proxy votings. But what we've also developed as a firm are what we call our proxy voting guidelines. And basically what we did is we looked at a set of the commonly voted items or key topics that were addressed in proxy voting, and you can see them at the bottom there. Things like board composition, executive compensation, shareholder rights, and shareholder proposals. And we tried to come up with a list of guidelines that would help our portfolio managers so that we were in voting, that basically they understood what best practices were around each of these items, and that allowed them to make sure that they were voting in a consistent basis. And so just to give you a snapshot, again, moving forward to what that actually looks like, in terms of some of those proposals, you can see an example around, next slide, please. Board diversity proposals would be one of them. And so a lot of board diversity proposals have been brought forward, and they generally take two forms. The first is where you're asking a company to just increase its reporting on diversity. So they're not reporting, or they're not transparent enough in terms of what kind of reporting they're doing. And I'd say the second type is really where you're asking them to actually increase the gender and racial minority representation on their board. So the first thing that we do is sort of get our general principle out there, which is the fact that we do believe that having a diverse board ensures that a wide range of perspectives are heard, and that ultimately leads to better decision making and effectiveness. And then what we do is we voting guidelines. So it talks about what type of boards or what type of practices we'll generally support. And so again, in this case, we generally support boards that do have written board diversity policies, and we support boards that generally exhibit evidence of or progress on diversity and board representation. And again, Joel's going to take us through some examples. We're going to sort of bring this to life a little bit more. I know there's a lot of information here, but it basically just outlines some of the circumstances that we would consider when we're looking at proposals on diversity. And it also outlines, as you can see at the bottom, best practices. So we look at best practices in developed markets. They do indicate that gender should be not less than 40% and not more than 60%. So basically in that balance of 40-60 for one gender versus another, and that would be sort of best practices. Just one more example I'll give you, and then I'll turn it over to Joel to go into some actual real life examples. But so one of the other key areas that we get a lot of proposals on are climate change proposals. And again, there's a number of forms these proposals can take. Some of them are around climate related disclosure. So just understanding what companies are doing with regards to climate and how it's impacting their business. Others are around their emissions reduction targets. So what kind of emissions, what their footprint looks like today, what their emissions reduction targets look like. And the third is really around climate transition action plans. So how are they preparing for the energy transition that's happening? What kind of plans do they have in place, and how are they managing that process? And so we think that all three of these things are very, very critical. We're definite believers that climate change increasingly represents significant risks to the business, and that preparedness is a source of competitive advantage. And so we really want to make sure that we're understanding what companies are doing and how they're managing those risks. And so the guidelines are designed to address those factors. And again, Joel's going to take us through some examples that I think will bring that to light. And so maybe with that, I will turn it back over to him, and he'll go through those live examples.
Excellent. Thanks, Michelle. So on the first slide here, I'm going to give two examples. One is a diversity target proposal that we voted for, and that was voted for in 2021, so last year. And the second is similar thing, diversity target or diversity reporting, that we voted against that proposal, and that was this year, just a few weeks ago, actually. So the first one was a proposal from or for RBC and TD. And essentially what the proposal was to encourage adoption of a diversity target higher than 40% at the board level. So basically minimum of 40% female representation at the board level for the next 5 years. We decided to vote in favor of this proposal. Now it's very interesting to note that the banks at the time already had, for the most part, met that 40% threshold. I think one bank was at 38%, another at 36%, and the rest were above 40%. So they were all pretty much in the ballpark, which is a positive. And so the reason we decided to support this proposal was really to ensure that the diversity level would not decrease over time. So we weren't trying to ensure diversity was increasing. We were trying to ensure that over the long term, that target percentage did not decline. And one of the things that we really focus on with these kind of proposals is, are they overly prescriptive? So are they placing an unnecessary burden on the management team or board and asking them to put out an unnecessary report, or unnecessarily forcing them into strategies that they're already considering at the board level, basically telling them how they should be executing their strategy. So we did vote for the RBC and TD diversity target, as I mentioned, but one that we decided to vote against was for Metro just recently. And essentially what this proposal was to publish an annual report on the representation of women in the corporation's management. So we absolutely support that, and like Michelle said, believe that having a wide range of perspectives, both at the board level and throughout management, is very important to long-term success of a company. But Metro already discloses information around gender diversity at the board and senior management levels, and they do have a diversity policy in place, which they reevaluate every 2 years. So for this proposal, we ultimately decided that it was overly prescriptive and was to some degree redundant with what the management team and board already had in place. So that is two examples of diversity targets. And then the next two that we have are on the climate side of things, just to contrast a little bit. So on the next slide, we've got the first, which is CP Rail proposal. And this was, I believe, last year, 2021. And then the RBC proposal that we voted against was from this year. So with CP Rail, essentially what we had was a proposal brought forward to hold a vote every year on the company's climate action plan and their strategy to reduce GHG emissions. So basically what this vote would allow us to vote for the foreseeable future on how the company was doing on mitigating climate change and reducing their own emissions. Now, the reason we voted for this proposal was CP was not already providing this kind of reporting and hadn't provided a thorough reduction plan. So we decided that this would encourage them to do that and to hold them accountable and encourage them to report annually on their progress. So that's why we voted for that one. Now, if you look at RBC, to contrast, this is similar to the Metro example where we did believe it was too prescriptive. So basically, this proposal was introduced to encourage defined GHG emission reduction targets, and then also for the bank to provide an annual report on their progress. So the bank already does a lot of this in one form or another. So they do have climate change report, they do have a sustainability report, and they have emissions reduction target. So they're all of the Canadian banks are leaders in how they think about ESG and how they're planning to reduce not only their own emissions but also encourage reduction of emissions within their business. So the companies that they finance, and that would be Scope 3 emissions. So a lot of them are focused on reducing those emissions as well. But essentially what we decided was this is redundant for RBC. They do publish these reports and they will be measuring and reporting finance emissions starting this year. So again, we decided too prescriptive. They're already doing these things. That places unnecessary burden on that management team. They can execute on what they're currently doing, and that is enough for now. So the next slide, we've highlighted some trending topics, and we can discuss a bit more of this in the question and answer period on things that we're seeing now and some interesting proxy topics, for example, or proxy proposals. But I don't think you'd be surprised by these. There's definitely an uptick in climate change and environmental impact related proxy proposals. Human rights have for a long time been important. Diversity and inclusion definitely trended up over the past 5 or so years. Cybersecurity is becoming more and more apparent, especially with what's going on in the world at the moment. And the last two would be lobbying and how companies are supporting certain political affiliations. And lastly, human capital management. There's a variety of topics that would fall under that, but we do often see proposals that would fall under that. This next slide here is that white paper that Michelle highlighted that was circulated, I believe, yesterday or a couple of days ago, and focused on engagement versus divestment, but really highlighting that if your goal is to bring about societal change, engagement is a much more suitable approach than divesting. So I think to end, I'll just quickly summarize what we've talked about. I think this is 2 slides ahead. So corporate governance has always been a key quality indicator in Guardian's investment process, and we do have a very high level of quality in the portfolio. So like I said at the beginning, we don't often find ourselves using our proxy votes or the proxy votes to vote against the management team. Our teams are constantly engaging both on proxy-related issues, but also broader ESG or sustainability issues, and ensuring that management teams are being progressive in the way they think about the economy at large. All proposals must be, of course, carefully evaluated in the context of the company and its peers and the country in which it operates, as Michelle discussed. And it's important to assess the benefits of each shareholder proposal. Like I talked about, there's often quite a few proposals that can be overly prescriptive or unduly burdensome to a management team or board, and essentially unnecessary to place that burden on the management team. So that, I think I'll take a breath and open it up for Q&A.
Thank you very much, Joel. If anyone has questions, we have a few already in the Q&A box. If you have more questions, feel free to enter them there. But yeah, let's just go through some of the questions that have already popped up. First one being, how often do you vote against management? And I'll add to that one. Are there any topics that you're more prone to vote against management than other topics?
So, I mean, I think it's interesting when we look at sort of that breakdown, the slide we had, which showed kind of the breakdown of actual votes that we make. And so if we look on an overall basis, we would tend to vote against management probably somewhere in the range of 2 to 3% of the time. But if you actually break that down between management proposals and shareholder proposals, we generally vote against management proposals very little, but against shareholder proposals, we vote against them about 24% of the time, if we look at our 2021 results. So again, it just depends on sort of the breakdown and what you're voting for. And I think that Joel gave some good examples of the types of shareholder proposals that we would vote in favor of. Even if we think a company is doing a good job in general, like CP, maybe they just haven't gone quite far enough, and we want to sort of just indicate to them that we'd like them to go a little bit further in terms of the reporting that they're doing and really setting some of their targets on the climate side. I would say in terms of issues, again, so it would really be under that shareholder proposal bucket. So around climate, around diversity, around environmental, human rights, those would be sort of the typical issues that you see under that shareholder proposal bucket.
Thank you very much. One thing that came up in the presentation is related to divestment. You prefer to engage rather than divest. Have there been examples where you actually had to pull the trigger and sell because the company didn't live up to your expectations?
Absolutely.
Yeah,
I mean, I think that, oh, sorry, Joel, I'll let you go ahead.
No problem. Yeah, I think a recent name that we've exited post-engagement would be Rogers. So I'm sure that a lot of you would have read of the Rogers boardroom drama. And we did engage management teams, discuss their plans there, how they would evaluate governance going forward and ensure that this kind of event didn't happen again, where you have essentially hostility within the board and another management turnover right as you're going through a generational acquisition. So Rogers, for those who don't know, is acquiring Shaw, which is has been a long time coming, but is a very significant acquisition. And you wouldn't exactly want your management team to be distracted during that critical period of integration. So we ultimately did decide to divest the name as we were not comfortable with the governance profile of that business. Now, if you think about the implications this has, it is a dual class share structure. So you're always going to have the voting power with the Rogers family. So how do we evaluate that going forward? Because there are other portfolio holdings that do have a dual class share structure. So it's very important. So what we've found historically is there are boards that are willing to engage and management teams that are willing to engage despite the fact that they hold the voting power and they're willing to answer the tough questions. And those are the companies that we are comfortable holding. Now, that being said, I think that the Rogers Shaw board saga was a little bit of an eye-opener and awakener for us that we do need to be very on top of those dual-class share structures and ensure that the voice of the minority shareholder is, one, heard, but I think more importantly, willing to be heard, and it's not just paying lip service to a minority shareholder.
Very good. Thank you very much. Another question. A lot of the topic of the presentation is focused more on the G side of the ESG, the governance. Do you have any specific guidelines for the E and S of the ESG equation that you would look to when voting proxies?
Yeah, I mean, I would say first and foremost, I think that it's interesting because it's kind of our view that governance is where things start, right? And so when we're looking at things like climate change, companies are addressing them and energy transition and things like that, in order to have a strong plan in place, you need to have good governance. And so governance is sort of the first thing we would look at. We would look at what the board is doing. We'd look at what kind of oversight committees are in place to really understand how it was being managed within the context of the company. And then that generally feeds into strong practices around both S and around E. And so it's kind of that's sort of the first and foremost. And I would say that the way that the proxy process is set up, it is focused predominantly on the governance side because it's around the board of governance, the board of directors, pardon me. Now, I will say, you know, there are certain issues. So for example, we would consider diversity as much of a social issue as it is a government issue. Climate, again, would be considerably environmental. There are definitely social aspects to environment. And so I would say there's a lot of overlap between these areas. And so the way that our guidelines are designed, it basically addresses sort of the most typical areas that are coming up. But so I think Joel alluded to the fact that human capital management, it's around, you know, how you're dealing with your labor force, how you're dealing with the communities that you're interacting with. All of those things would be addressed in our guidelines as well.
I wouldn't mind actually just jumping on with a quick example there to specific to what Michelle just mentioned. There's a holding in the portfolio called Agnico Eagle Mine. So it's a gold producer that operates in Canada out of Nunavut. And so quite interesting from a social standpoint because their success has largely come from how willing they've been to engage the local communities. And so what I mean by that is if you look at their workforce in Nunavut, they really strive to have about a 50-50 balance between experienced workers that would come from places like northern Quebec that have historically been gold towns or gold cities, bringing those experienced leaders up, and then taking 50% local Inuit population, training them, and really giving them the skill set to not only do entry-level jobs, but to succeed within the organization and ultimately become leaders. So we've seen that firsthand. We've been up to Nunavut. We've seen how engaged those people are. And I think the benefit that has longer term is you're really allowing those people to flourish, but also those communities to flourish, right? You've educated, you've developed a skill set that otherwise wouldn't have been there. And so it's quite fascinating and compelling to see the company's willingness to do that versus just flying up a completely independent workforce. I think that speaks to the social side a little bit.
Great, thank you very much. Just to change it pace a little bit, executive compensation comes up in every ballot we see for every company. For the layperson, seeing the salaries and bonuses and stock bonus amounts that are given out, how do you put it all in perspective? How do you measure an executive that's getting big bucks and whether that's a fair and reasonable amount? How do you assess this? How do you form your opinion on whether or not to approve the board compensation?
I can start and see if Michelle wants to add anything. So I think you're absolutely right. There's often some sticker shock if you see some of the amounts that CEOs, CFOs will get paid. What we really focus on, the absolute level is definitely a challenge and will always be, I'm sure. I mean, what is $14 million versus $15 million or $16 million? It's hard for us to opine on that. But what we do really try to do is focus on two things. The first would be, is the structure of the compensation set up appropriately? And so we would not at all favor a CEO that is incentivized to grow the share price or to be compensated on total shareholder return. We'd instead really look for an incentive plan that drives longer term growth of the business. So it would be structured around things like return on invested capital, which is what you would really look to see to measure longer term growth, but also profitable growth within a business. So that's one aspect, is the structure appropriate? But the other is benchmarking to peers. So we do have a lot of world-class talent within Canada, especially at some of our larger corporations. And so we're able to benchmark what they're getting paid versus some of their global peers, right? So the risk with an executive is that another company, given they're a world-class CEO, would look to bid that talent away or take them in as their own CEO. And so I think that's the one thing that we would do the most, is ensuring that within a peer group, the pay is comparable and reasonable.
Good. Okay. There was also a question from the audience on diversity. How do you define diversity, and can you elaborate on how you address diversity issues?
Yeah, I mean, it's a good question. And I would say typically what we're seeing in most of even the diversity and inclusion policies for boards and for management teams is it has traditionally been focused on gender lines. But over the last number of years, you've started to see it expand outside of gender to incorporate a lot more of sort of the other characteristics that we would consider in diversity. So things like ethnicity, background, sexual orientation, accessibility characteristics, things like that. So it's becoming a much broader sort of category. What you're starting to see is, I would say, the policies and the things that we're evaluating haven't necessarily expanded at quite the rate that you're seeing, or you're seeing that sort of, I would say it's starting kind of within the workforce in terms of the expectation, as opposed to kind of in the senior management and the board level in terms of those expectations. But I would anticipate that over time, that definition of diversity is going to continue to expand to become much more encompassing of just gender, which is what it's predominantly focused on today.
Okay. One last question. You noted that you use ISS to help you out with the proxy voting. I'm assuming that your PMs or your team will also have a view and not just take their recommendations verbatim. What do you do if the recommendation from an alternate proxy service research company is different, or the internal view is different than who you've contracted to provide this advice? What do you do if you get a conflict in how you're supposed to vote or why you're supposed to vote it?
I mean, I think it's really important that, ISS is really just providing a perspective, right? And really our view is that our portfolio managers are best placed to understand the dynamics of the issues and the dynamics of the company in the context of which that sort of issue needs to be sort of considered and placed. And so we feel that it's really our portfolio managers that are the key decision makers. And so while the ISS analysis is an input into that decision, it's really their knowledge of the company, their relationship with the company, their proprietary research that's allowing them to make the decision. And we feel that they're going to make the best decision and best position to have the knowledge that they have. What we will do is if ISS has a decision that is different than what our portfolio managers are thinking, we do sometimes use Glass Lewis to get a second opinion to see whether or not those perspectives are the same or are they different. But again, that would just be an additional input into the process. Where we do disagree with ISS or those recommendations, we do make sure that we are documenting the rationale for our decision. And so we do that with all votes where we're voting against either management or ISS, so that the portfolio management teams are sort of, basically putting together what the rationale is for the decision, similar to what you saw on the page, why they're making the decision they're making, what are the factors that they're considering, and why they feel that that's the way. So that is available for clients and companies if they want to see it. But again, our portfolio managers are the experts, and so they're ultimately the ones that need to be making that decision.
I can give an example there of one last year that we spent a lot of time on. So Gildan, which is an apparel manufacturer, they would make basic t-shirts, underwear, socks, things like that. We spent a lot of time engaging the board at Gildan this time last year during proxy voting season, because ISS had voted or had suggested voting against the management compensation plan, whereas the board had encouraged to vote for. And so the time we spent engaging the company was really focused on why was the pay level so high. ISS had deemed it excessive, and it was excessive versus the prior year. But what we really spent time understanding was, one, how did the CEO's compensation compare to peers? So Gildan is the leader in what it does. And so the management team, or the board, felt that they needed to provide a higher level of compensation to make up for the past 2 years where the CEO had depressed compensation versus his peers, to ensure that they were able to retain that talent in-house. And the other thing that happened was they actually granted some one-time stock options. So if we rewind to the very beginning of COVID, the company's guidance had already been set, which meant that the management team's compensation levels, or the execution targets that they needed to hit during 2020 had already been set in order for them to get a full payout on their short-term incentives. Then with COVID, obviously supply chains shut down. They had a very challenging time managing the business. And so longer term, over the 2020 period, they did not hit those revenue growth and profitability growth targets that they had set at the beginning of the year. The board decided to nonetheless give one-time stock options because they thought that the management team did such a fantastic job managing through the volatility and positioning the company to come out of on the other end in a much better place. We completely agreed with that, and so we're able to engage with the board, discuss those targets, get the compensation committee's input into why they thought that was the case, and then also talk about forward-looking targets and when they would integrate things like ESG into compensation. So yeah, it's definitely a big focus on engagement if that does occur. But lo and behold, to no surprise, Gildan's really come out of this and has seen massive market share gains, extremely well positioned. And so you really need to make sure that your company does not lose its key talent at a time like this. So that's why engagement is so important to understand all the dynamics at play within a compensation package.
That adds a lot of light. Thank you very much, Joel. Another question, can your clients influence how you vote? Or put it slightly differently, are there instances where different clients, their proxies are voted differently than the rest of your clients?
So I would say that generally what happens is we do have a handful of clients that elect to vote their own proxies. So it's generally when we're opening an account, it's a discussion we'll have with the client. Our default is that we would vote all of the proxies that we manage. But in particular, we have certain pension funds or endowments that have their own proxy guidelines and want to vote their own way. And so they manage their own proxy voting. Generally, what happens in those cases is that they might make us aware. So for example, we have a particular client that gives us a copy of what their guidelines are. And basically the interaction we have with them is if we want to influence a vote that they're having, or if they want to influence a vote we're having, we will have a discussion with them. But again, that becomes just another input into our decision-making process. They're a single client with a single perspective. And oftentimes with this particular client, they actually had they were planning to vote one way. Our portfolio management teams were planning to vote. They had a discussion, and ultimately was the one that ended up changing their vote. So it's really just a discussion and engagement. We do think influence is important, and using our position as an institutional shareholder to influence our clients as appropriate, or to influence others in the industry as appropriate. But that's really how that process would work. Wonderful.
Well, it is approaching noon. I think we've had a very comprehensive discussion on a topic that I'm sure is not the forefront for the bulk of our client base, but that's exactly why it adds value. I want to thank the presenters for joining us and sharing their knowledge, and I want to thank everyone who joined us for the presentation. This presentation will be available on our website afterwards if anyone wants to go back and review or show it to your friend, whatever it might be. And again, thank you very much for joining us today.